Hi everyone, I'm Tom Hamp and I'm excited to welcome you to Restaurant Finance 101 here at the Hospitality Training Institute of Michigan. Thanks for joining us for this two-lesson course. Over the next couple of sessions, we'll break down the numbers that matter most when running a restaurant. Profit and loss statements, prime costs, inventory, food costs, portion control, and more. Don't worry, this isn't rocket science. It's practical, simple, and designed to give you the confidence with the financial side of the business. So grab your seat, relax, and let's dive in. Restaurant Finance 101. So over the course of this lesson, we're going to talk about a few things, primarily the profit and loss statement or report. And then everything that we talk about after that kind of fits into that report. So it just kind of is intertwined. The things that we talk about at the profit and loss level will be about the 30,000 foot view. And then we'll get into some of the details which come out of the profit and loss or affect the profit and loss report. So some of the things that we'll talk about are the different formats of a profit and loss statement. We'll pull up some samples so that you can see the differences in some profit and loss statements or reports in different inventory or in different industries. We'll talk about revenue, direct costs, indirect costs. Those three potentially have different names as well, so we'll try to talk about that a little bit. We'll talk a little bit about prime costs overall, spend a little bit of time on that. We'll talk about sales per square foot of a facility. We'll talk about the controllable income, potentially the occupancy costs, and then we'll wrap everything up with some conclusions and insights. So we believe there are three core competencies that every independent owner or a management team must have to create and sustain successful, profitable restaurant business. They include implementing effective systems, building a strong, positive culture, and something that we'll probably talk a lot about in this lesson is developing business skills. First, effective systems. Most successful restaurants have effective systems, processes in place. Because when they get busy, and they will get busy, we need to lean on those processes and procedures so that everything can be done on a smooth and efficient manner. It also helps ramp people up when they're new to the training, because if everybody knows this is the way to do things, everybody can agree that things will go much smoother if everybody knows the system that they'll be using. So systems are certainly required to organize operations to provide customers with a consistent, reliable guest experience. As an owner and manager, you also have to create that strong culture, that team atmosphere, that when employees come to work, they love stepping right in and doing the things that are necessary. And again, when you're busy, the way the team operates can be really advantageous to the property and the facility as a whole. So a strong culture is needed to encourage staff, to foster teamwork, ensure excellence, and again, provide that exceptional guest care. And then what we'll be talking about today, using the business skills, right? That you want to grow and understand the business part of the restaurant, because we want to control costs. We're in it to kind of turn a profit. So control costs, making sound decisions based on the numbers, and ensuring adequate profitability, not only today, but as we move along into the subsequent months, quarters, and years. So understanding the P&L statement. So the P&L statement really is the cornerstone of business management. And again, as I spoke before earlier, it is prevalent in almost every business, or should be. Especially in dynamic industries, ones that can change quite quickly, like the restaurants, where small changes can significantly impact the bottom line. If we have a increase in a price somewhere, it's really going to affect other things on the profit and loss statement. So when we use that profit and loss statement, it really reflects the financial impact of marketing, training, purchasing, and daily operations, and gives us a good tool to assess what's happened in the past. Now remember what I said there, what's happened in the past. We'll delve a little bit into that nasty word accounting, only for those of you that may not be your favorite subject, but accounting really is the system of measurement that converts the decisions that you or upper management has made and the activities into numbers that kind of reveal the true performance of the business. So decisions that we've made about different things in the business, the numbers, the P&L will reflect that going forward. So again, it's just a great way to understand whether the decisions that we made were successful or that we need to continue to tweak them so that they become successful. We talk about 3 undeniable truths. What gets measured gets managed. That means if we're keeping track of it or we're monitoring it, we're going to manage it better, especially if we have benchmarks to compare it against. What gets managed improves, right? So we want to make sure that we get those numbers that we really come to understand can tell us the success of our business. How can we improve those? What levers can we pull? What buttons can we push to make sure that that's successful for us? And then profit improvement begins with measuring key activities. So your P&L, it kind of measures results of decisions, activities. So again, this is stuff that's really happened in the past. It's the accumulation of all those numbers over the last month, 2 weeks, month, quarters, year, that type of thing. It certainly highlights your area for improvement, but it also helps you manage your restaurant effectively and profitably. Okay, so your standard P&L format will include sales, food and beverage sales, right? Also, we're going to understand what the cost of those sales are. It includes any prime costs. So this could be the cost of sales and payroll, which we'll talk about. Any controllable expenses that we may have out there, any non-controllable expenses that we have out there. And then the bottom line, your net income, or something else we call profit. So we have revenue or sales, we have expenses, which could be direct or indirect, and then we have our net income or profit, either before or after taxes. So when we move into actually seeing what a P&L looks like, we're going to compare them here in just a second. So a standard format kind of provides actionable insight. So if your P&L is set up for your industry, it makes it a lot easier. And I'll show you that example. A non-standard format really limits. So we have to get out the calculator and kind of calculate the numbers that we want to look at, that type of thing. So I'll show you how that works here in 1 second. And then using industry standard formatting for clarity and better decision making. So the first P&L that I want to bring up is really a basic one, one that that almost any business can use. It's not necessarily from one business, but again, it shows you that. So this simple profit and loss statement up here is revenue. Revenue and sales are interchangeable. So anything that comes into the company will be on the top part. So we have revenue. We both, in this situation or this example, we have sales revenue, and then we have service revenue, and then we get a total of those, added those together to get 150,000. Okay. The next area down here is what we call the direct expenses, or the cost of goods sold. So they really abbreviate that as to be COGS, but cost of goods sold. And this is interesting expense, is that this expense is everything to produce the product or service that you're selling. So it can be tricky, but I'll give you some examples here. So in the cost of goods sold, if you're making a car, the materials and the labor to make that car go into the direct cost. We'll talk about indirect expenses here in a moment, but those are direct costs because they go directly in making the product or service. So you see here for materials, we had a cost of $25,000. For direct labor, we had a cost of $15,000 for a total of $40,000. And how we get our gross profit is we take the revenue, $150,000 minus $40,000. We get a gross profit money of $110,000. And so again, your direct costs, we kind of get your gross profit. We can take that a step further, and you'll see this on another sample, is that we actually get the profit margin as well. And that's a good indicator on where we need to be, either comparing that number to ourselves or competition or to benchmarks in the industry. So just a really quick recap: revenue or sales up here, our direct costs here. And then we get down to what we call the operating expenses or indirect. This is everything that costs us money, but it doesn't have a direct interaction with the product or service that we're selling or that we get income for. So things like salaries and wages for those that might be just in the office, the rent that we pay for the building that we work in or that we store stuff in, any utilities for heating and cooling and electricity and those types of things, our marketing, our office supplies, any insurance, those types of things. Those represent our overhead, another name for it, operating expenses or indirect expenses. So if you add those up, we get a total of $68,500 for a total of 440. So if we take $110,000 gross profit minus our $68,500, we get $41,500. Now, I'm not a big fan of this, but I know some P&Ls put all this miscellaneous stuff, other income and expenses. I like to show it income up here, and depending on what type of expense it is in one of the two columns, as opposed to putting it at the end. But what we like to look at here is whatever we have left over, our net profit, our income tax, the tax that we know we're probably going to have to pay in March or April of the next year. And then whatever we have left after taxes really is our net profit. And so that gives you a good idea on how a profit and loss statement works. One more time: revenue, direct cost or COGS, indirect cost, overhead or operating expenses, and then our miscellaneous stuff down here, and then total it all up for our net profit. Now compare that, and this next sample is going to get really busy. This is going to be by month. It's a completely different industry. This is a company that sells pools and installs swimming pools. So the numbers here are much higher, and you can see that they actually have it per month. They would like to see their profit and loss per month. Now, a facility that you might work in might not do it like the previous example, which would be a year. They're probably going to do it on a much smaller time frame. They might do it every 2 weeks or every 4 weeks. Just depends on how it's been set up. This one happens to be every month. And so same thing in this situation. Our incoming revenue, whether it's pool shells or shipping and delivery, is here. Okay? And because there's no shipping and delivery, or there wasn't in any of these columns, it really just flows down to the total. So the total revenue is here. Then we get to the next section. If you remember from the last example, direct costs or cost of goods sold. Everything that goes into making and installing the pool is down here, right? From the fiberglass materials to make the pool, which seems to be the largest expense. Those pools are big, so the hauling expense is relatively big. Maybe they need a police escort because they're pretty wide and they go through traffic. And then the direct labor to get that unloaded either via a crane and then put into the ground. So again, a lot of direct costs here. And then you see by totaling that up, taking the revenue up here, minusing the total direct costs, you get a gross profit down here. And then you take that, whatever that is, and divide it by the revenue, 109 divided by the revenue, and you get how much of your gross profit is of your total. So what you want to see here is that it flows down to your gross profit. So you see 182 minus the 109, you get 72, and then you take your $182,000 worth of revenue and divide it into the 72, and it gives you your gross margin. As you can see, as it goes across here, you can keep track on how well you're doing with your revenue and expenses compared month over month. And in your situation, the restaurants, it might be compared every 2 weeks, but again, it's a good indicator of where we are. Okay, whether the revenues go up or the revenues go down. And now just reviewing the last or the third section down here, this is the overhead, the indirect costs, or the operating administrative costs. And again, you can see things in there like training, bank service charges, marketing, non-cost of goods sold, hauling and freight, any permits, lease payments, taxes, telephone expenses, utilities, and then any payroll salaries, any benefits that you have to pay, retirement expenses, FICA and medical expenses, that type of thing. And we come down here, get our total. And our total could be in the positive, like this column, or it could be in the negative. We don't want it too many negatives because now that becomes an issue going forward. So again, as you can start to see across here, they're holding a pretty good level of positive net profit, which is always very, very good. So those two examples were pretty generic for other industries. I want to bring up now a profit and loss from potentially the restaurant area and see how it looks different, right? So a restaurant P&L format, we certainly want our sales up at the top, right? Anything incoming, our food and beverage sales and any other operating income, and we get a total. And then we get into our COGS, cost of goods sold, right? And we know that directly we sell food and we sell beverages. So that's pretty direct. And so those are the cost of our sales. But what I've done here, or what the industry does here, is really take our labor out of indirect and we really put it up into our cost of goods sold, or up near cost of goods sold, so that we can get a handle on it. And the reason we do that is that we want to come down here to prime cost, is that we know our prime cost is basically our food costs, our total cost of sales, so it'd be our food and beverage, plus our labor costs, and that will give us our prime cost. And the reason we pull it out of there and put it in its own little row here is that otherwise we'd have to take out our calculator each time. And by doing it this way, we have it at our fingertips. So for the current period, the percentage, our prime cost was 72,360, our percentage was 68. Compare that to our year to date, we're a little above. Now, that could because maybe we have higher cost, either a higher labor cost or a higher food cost that we were not expecting. But again, it's good to have this in front of you. You can see it right here, 68.6 versus 67.3. So it kind of gives you just an idea on what's going on. And then some of the other stuff, the expenses, we still put in our controllable, which is our direct operating expenses here, our indirect or non-controllable, and then some of the other income and stuff like that we have. But this row right here is absolutely the most important, is that's our prime cost, and we want to know that almost at our beck and call, because again, that's what we're getting compared to. We want to know if there's been any anomaly, any pricing spikes, any labor cost spikes, those types of things. So that's why prime cost becomes utmost important. So how do we use these numbers to our advantage? So we just talked about that row, prime cost, managing the most important number on your P&L, right? I would say that, profit is directly reflected by what the prime cost is, because if it's too high, there won't be any profit. It'll be in the negatives. And if you've got it in a nice sweet spot, your profit's going to be decent, and you're going to make a lot of people happy, including yourself. So you probably heard the saying that goes, in business, you can't cost cut yourself to success. Well, while this is true in most situations, there's only so much you can do. In the restaurant business, controlling cost is vital. So we need to stay on top of our costs, both food and beverage, right? And then the third place that we need to stay on top of is our labor costs, because those can get out of whack. Especially we know we're hiring right, we're training people, we have them scheduled, somebody calls off and can't make it, we bring somebody else in. So again, food, beverage, and labor costs can really significantly impact your profitability. So many high volume independent, not the chains, but independent restaurants struggle with poor systems and control. It may have been solid at one time, but as time has went on, maybe people have gotten away from their processes and that type of thing. Some of the things that get in the way are issues like waste and spoilage of foods, because we're not keeping close enough eye on what's in the inventory and what we should use first. There's theft that can be there, poor scheduling. All these things can quickly lead to significant losses. So we need to stay on top of that And the prime cost number percentage, the percentage of that really helps us monitor that to great detail. And then without solid systems, we know that restaurants often face underperformance or possibly even failure. So again, prime cost is the sum of food, beverage, and labor costs. All three of those. We had that on the profit and loss statement, which is great. This number often accounts for over half of the restaurant's total expenses. As you saw in that example, high 60s, 67 or 68%. It's high. We'll show you coming down the road here on what they really should be based on the type of restaurant that's being run. And then understanding and controlling that prime cost through different things that you can do is critical for improving that profitability. Believe it or not, by managing and monitoring prime costs, restaurants can actually reduce their costs by 2 to 4 percentage points. If they do that, if they can reduce their costs 2 to 4 percentage points, you actually can result in a net income of 20 to 40%. It's been proven time and time again. It comes right out in the profit and loss. So if we're keeping good controls and monitoring on our prime costs, we can really change the outcome of a quarter or a year of managing the monies in the financials in a restaurant. So make sure that we're on top of those things going forward. Another thing you could do is educate staff and fostering accountability, right? That this is why we're doing this, because if we're getting increases in profit in net income, that means we can share more for potential promotions and salaries, benefits, those types of things. So everybody should understand how a restaurant needs to operate, wants to operate going forward. So here's where we talked about the numbers. So if we can focus on prime costs, there are many examples of reducing prime costs from over 65%, which you saw in the example, P&L, to the mid 50%, okay? And then how can this be achieved? Well, we can achieve that through consistent monitoring, reporting, and team discussions, right? What's getting out of whack, who's doing good, those types of things. So again, going back to prime costs, restaurants' total cost of sales, which again is food and beverage costs, and then of course adding in the labor costs. So here in full service restaurants, it includes food and beverage costs, and in quick serve restaurants, a little bit different, it includes the paper and disposable product costs. So a little bit different there because they have a little bit different structure and operating system with the way they serve their food. Separating out labor costs in prime costs, it really, you think about just the wage, what we're paying somebody per hour, but there's more to it than that, right? So labor costs certainly includes the gross salaries of owners, the management staff, and hourly staff. It also covers payroll taxes and benefits like workers' comp, medical insurance, and other employees' benefits. So we have to make sure that we get that under control. But remember, there's a place that will take all that consideration. All we have to make sure is on a month-to-month basis that we put in the proper numbers so that we can see an accurate percentage of prime cost. Won't spend a lot of time on this. This is the owner compensation. Just kind of a rule of thumb. If an owner's salary is included in the prime cost, only if they're actively involved in the daily operations. If they're a silent owner, then you're not going to include them because that really doesn't, that will really throw the prime cost off. And then non-active owners' wages should be shown as a separate expense, right down in the indirect expenses, kind of on the owner's compensation. But again, don't want to get too much in the weeds there, just kind of a rule of thumb going forward. The importance of prime cost, it's that indicator of profit potential. That doesn't mean if our prime cost is in line, it's in the mid 50s, that we're going to have profit on the other end, because there could be some other issues, but it's a great step toward that and good operational management. So high prime cost really often reflects issues with product consistency and food quality, or potentially other things. But again, high product consistency, making sure we got the right products, and then the food quality, we're buying right, that type of thing. So here's where what the prime cost should be running depending on the types of restaurant that you're running. So for table service restaurants, prime cost should not exceed 65% of net sales. So a great number to compare yourself against. That's a starting point, and we need to get under that. If it's much over that, then the restaurant could be in some financial troubles down the road. For those fast food, quick serve restaurants, prime cost should not exceed 60% of net sales. So again, maybe you don't have to staff it as much. There's not as high of expenses there. But again, those are the kind of the two running numbers for those two industries. So when we're talking about what it should be as far as a maximum, what does it look like when we're operating really well? So successful restaurants really often achieve prime cost as low, believe it or not, between 50 and 55%, right? So this allows net income margins of 20% or more. So again, out of every dollar, we're making at least 20%, 20 cents on the dollar as far as profit. Again, we're talking profit or income here. So that's extremely good, especially in the restaurant industry. And there are restaurants that are operating here. It's not easy. It's difficult. You got to be on top of your game. You got to have some things helping you out, such as employee accountability, making sure that you're monitoring things properly. Again, this is a great tool to be able to make sure that you're being successful in your income. Some of the challenges, obviously, minimum wage increases, because there goes up your labor and other costs in food, other areas that will increase. That will have to make an increase in your menu prices. So again, that will now start to inch up that prime cost. So you need to be on the lookout for that. And then combine cost of sales and labor costs into prime cost for better management insight. So we want to make sure that we're staying on top of it at all times. So when you're looking at food and beverage and labor costs within the context of prime costs, it really provides that clear view of profitability. That's where we need to start, right? You can still have high food costs, but still be profitable with low labor costs. It just depends on the structure of the restaurant that you're monitoring or that you're employed by. So how often should we check prime costs? Well, I will tell you that understanding the importance of calculating prime costs weekly for improved restaurant profitability is probably the way to go. We don't want to wait. Food costs, things happen in the hospitality industry that it happens pretty quick. So we need to stay on top of a lot of the costs out there so that we can also change things. If we need to increase pricing, if we need to change suppliers, if we, need additional employees, those types of things. So we have to understand what we're looking at, how we're tracking it, how we're monitoring it, and act accordingly. So obviously talked about how crucial that prime cost is to the restaurant's success. That weekly provides that, analyze it weekly will provide that timely insight to manage the food, beverage, and labor costs, right? And help us get a good start on this. Some of the benefits, again, the food spike costs, whether it's beverage or labor, we can catch that earlier and maybe do something about that. Accuracy and accountability. We'll talk about inventory later, but again, we need to have accurate counts on stuff so that we get the right cost. And then if everybody's in the know about prime cost, there's more accountability, right? Where people know we're watching and looking and counting stuff and making sure that we got the right things going on, and people go, okay, I need to be more responsible as well. And again, if you see something that's creeping up over a week's time frame, boom, we can do something about that as opposed to wait until the end of the month or the end of the quarter. Because we've noticed something in the prime costs over the last week, now we can take immediate corrective action. And then it certainly increases the profitability and operational awareness. Listen, if all the team is on board with understanding what prime cost is all about, they're more apt to help you in managing that, right? So again, maybe it can be as simple as offering to go home during slow periods, those types of things. So again, just want to make sure that you understand that some of this stuff can be controlled rather easily, and then some of it can't. The financial impact really, so here's a sample, here's an example. Reducing prime costs from 66 to 64% in a restaurant with only $700,000 in annual sales. So all we're talking about here is lowering it 2%, right? Net increase. If we do that, there's a net increase from 35,000 to 49,000. That's a 40% increase. So in reducing prime costs by 2%, we've increased net income 40%. A 2 to 4% drop in prime cost can really add up and increase your profit. So again, just want to make sure that we're looking over that. What are the numbers telling you? So once you've got your weekly prime cost numbers, the next step is to get an accurate sense of what the numbers are telling you and what are they telling you. So they always have something to say, and it could indicate strong sales and on target costs for sure. But it also can give you issues like a spike in food costs, or maybe somebody just made an error. And so, but we need to check that, because if that error is not caught and we continue to go down, then somewhere along the line, something's not going to look good. So we have to make sure we got accurate data. So discovering what that number tell you is called financial analysis. And this is where, like I said, it's not rocket science. You just need to follow the numbers, set up your P&Ls the way you need to read them, and what works best for you in analyzing your particular facility. From here, from those numbers, the P&L numbers, you can make great decisions, right? Your decisions and actions directly impact that financial result. But even by researching and doing an analysis, now you can make better decisions going into the forward. And better decisions make for potential better sales, keeping down costs, and certainly increasing those profit margins. So look at those dollar amounts and trends over a week to gain some of the insights. Compare percentages to benchmarks or prior periods. So really take a look at both the money, the numbers, the actual numbers, and the percentages. You need them both, because one may not be telling you all the information that you need to know. So high food or beverage costs, dropping sales mix, increasing labor percentage are all key indicators of potential issues. So again, these are things that you want to keep a close eye on going forward. So when you're doing this analysis, the keys here are investigate. If things are off, investigate portioning, right? Maybe people are eyeballing something on the plate that typically you would use a measuring cup, a certain scoop, or a weight, a scale to be able to measure the weight. So again, make sure that if there is issues, that you're verifying for accuracy. So investigate any portioning. Maybe we received the product from the supplier incorrectly. Again, the profit and loss will give you some indications that your food costs or your prime costs are off, and then now we need to backtrack. So maybe we need to check in how things are received and making sure that's accurate as well. Could also indicate theft. Somebody's either eating on the job or taking things out of the back door when nobody's looking. Again, gives us an idea that this stuff may be happening in our businesses. A sales mix. Maybe there's been a change. And the most obvious example is the change from a summer type menu to a winter type menu, or vice versa, right? So understanding what your prime costs are in your seasons, if you do have them, so to better understand what you should carry, those types of things. But it's great for an analysis. And of course, being able to schedule your labor properly and avoiding anomalies and that kind of stuff, some things that could prop up that might be special circumstances. So again, many examples out there, but a restaurant reduced prime costs by 65 to 55 by just monitoring these weekly reports and fostering accountability. It was let go before, they got their arms around it, and now their prime costs are certainly more acceptable. Benefits of those weekly prime cost reports, right? Better cost control, we're on top of it. Increase the profitability, improve culture. If we're winning, we're making profit, customers are happy, everybody's winning, right? And greater accountability among the staff. Make sure you make a commitment. If you get in a position to make a commitment to prime cost reporting, I mean, this is really, as we talked about at the beginning of this little section, it's the cornerstones of operations. It really will drive profitability and success. Some of the other things we just kind of want to hit on before we close the lesson today. Another number that you have to calculate, but you can also put it in your P&L, is your sales per square foot, right? So if you know the square footage of your facility, you can calculate the sales per square foot by dividing the annual sales by the total square footage. And it gives you an idea on where your type of restaurant should be based on industry averages. So a full service restaurant to break even should be anywhere between the 150 to 250 sales revenue per square foot. Okay, that's just to break even. On a quick serve, or excuse me, a moderate service restaurant should be the 250 to 400. And then strong profit. So let me go over that again. Full service break evens between 100 and 250 dollars per square foot. Moderate profits between 250 to 400. Strong profit is over $400 per square foot, right? And then quick service requires higher sales per square foot due to those different structures that I spoke about, right? So it just it's a different animal altogether. Let's talk about controllable income, right? So these are the profit before rent, property taxes, and other fixed costs. So this is the profit area. We want to make sure that we're controlling that. There's certain different things that we can do for that. When we're talking about full service restaurants, they want a minimum of 15% of the controllable income of total sales. A minimum. Anything higher than that is great, but a minimum of 15% should be profit before rent, property taxes, and other fixed costs. So again, trying to keep some of this other stuff, things like the rent and other of these costs down. Quick service, the minimum should be 20% of total sales. Another item would be the occupancy cost guidelines. Remember, there's other costs that we need to add together. And again, maybe we have I know prime cost had its own area. Maybe occupancy cost has its own area. Maybe sales per square foot has its own area. Again, you need to decide what's the most important for you. Occupancy cost equals the rent plus any insurance for that area plus the common area maintenance for that area. So for industry average, it's between 7 to 8%. Certainly 10% is manageable, but anything higher than that is problematic. So what's happening? Why is the cost, if it's 10% or higher, you need to know why it is higher. Again, if you can get it back down in the 7 to 8% range, that's great. But again, investigate these things. That's part of your analysis. And then focus on those strategies to address if high occupancy is out of line, figure out how to check those. So just kind of quickly going over sales per square foot indicates that potential profit volume, what you should be doing compared to others of the same type. Your prime cost, we spent a lot of time on that. Major combined expense category, understanding what that is. 65% or lower would be ideal. Your controllable income, making sure that you're controlling things so that you maximize the profit in your business. And then an occupancy cost is extremely important because really it's tied to your major fixed expense and it could be impacting profitability here. Okay, moving over to the importance of physical inventory. So we know, talking about the P&L, fixed cost, all that kind of stuff, but if you're not keeping track and being on top of your physical inventory, that could be an issue. And so we're going to investigate why it's important to take a physical inventory. So without it, your food cost, which is into your prime cost, on the P&L will be inaccurate. So not only will your food cost be inaccurate, your prime cost will be inaccurate, everything blows up. So you'll want to take and be on top of physical inventory of your products that you're selling. An example, if $14,000 is purchased, but inventory changes aren't accounted for, that real food may differ significantly, right? So if we can't account for that $14,000, and remember, inventory is fluid. There's not a time where it just freezes for an extended period of time. We have to take into account that stuff's always being added to the inventory and taken out of inventory. And that's a whole nother area that we'll cover potentially in the next lesson. The benefits for an accurate inventory, We know that skipping inventory adjustments leads to discrepancies, provides excuses for higher food costs. We need to know what those are because, again, it affects the bottom line. Accurate numbers hold staff accountable, right? No theft or eating stuff out of inventory. And so some tips for inventory. So again, there's a bunch of different ways to do that. We can do shelf ordered count sheets. We can assign different counting teams, or we can use some mobile inventory apps. Don't want to go too deep in this for this lesson, but again, inventory is extremely important. So I hope you enjoyed learning more about the P&L, and that you know this lesson has greatly increased your understanding. If you're having an issue about it, you know, make sure that you ask somebody. Maybe you may want to get a hold of the Hospitality Training Institute of Michigan. But again, key important in understanding how to run your restaurant here. In the discrepancies, you want to make sure of these things as we get down here to the end of the lesson. There is different methods of calculating cost of sales percentage. Some people use total sales, everything that's sold, and then some people use just the food sales. So you want to make sure that you're consistent. If you're using both food and beverages, it's going to be a much lower percentage than just using the food. So make sure that you're using the same thing each time. So ensure your P&L follows industry standards for accurate analysis. And then your office or your managers or your owners may want to see it differently, but make sure you're using it consistently. So from there, congratulations, you made it all the way through. Hopefully you stayed with me and understood many of the key points there. I want to acknowledge your effort here. I'm always impressed when, you know, people that are interested in the restaurant business take the time to make the effort to improve their skills and grow personally and professionally. So we certainly appreciate you jumping aboard. Remember, we want to make sure that we're managing our numbers. Understanding these numbers will really help you better. And it's not a full accounting, you know, curriculum here. It's just some of the basics that you have to understand. It'll certainly help you make better decisions and help you build a more profitable, successful business. And as I said, if you're still a little bit, you know, not sure of what we talked about today or not quite as confident, certainly reach out to the Hospitality Training Institute of Michigan. We will certainly help in any way we can. You know what? I want to thank you all for hanging in there today. I appreciate that you were with us. And that wraps up lesson number 1. Can't wait to see you in lesson number 2.